Hey, what is going on YouTube? Welcome back to another video. In today's video, I'm so excited to actually jump in because it is the intro video of the well-anticipated series on raising capital. Now, if you don't know, I've raised over $7 million personally at the age of 27 for my own real estate deals. I spent 3 years working for billionaire Grant Cardone's real estate team. I ended up raising over $100 million while working there. So I might know a thing or two about how raising capital actually works. I wanted to take some time and look at raising capital as a whole from a very high level perspective because you can virtually raise capital for anything in the entire planet. You can be a tech entrepreneur and go raise capital and start a tech company. You can go raise money from producers in Hollywood and you can try to shoot a movie. Or you can be like me and try to go out and buy real estate and use other people's money to do so. Learning this one skill set can and will change your life if you grip into it, you learn the foundation of it, and then you implement it and go out and actually take action. So let's go ahead and let's jump in. As always, if you find any value throughout these videos, all we ask for a return is make sure you hit the subscribe button, like, and most importantly, comment below the biggest takeaway that you took from this video and what you want to see in the next one. So jumping in very high level, what is raising capital? How does it work? So whenever you're trying to jump into real estate, whether it's small like single family homes and you're doing flips or you're trying to do multifamily, I recommend just skipping singles and jumping right into small multifamily deals. Regardless of what you're doing, you have two options. You can either go at it alone and you can find the deal, use your own money, and then buy it and keep 100% of the profits. That is a very simple business model to understand. Now, everybody runs out of money. It's like not a secret. Like you only have so much money. At some point after you buy enough deals, you start to run out. Now, the alternative, like raising capital. So how does it work? Raising other people's money, or OPM. You go out, you find a deal, and because of how profitable that opportunity is, you can then take it to investors and raise outside capital from them to help fund the purchase. So whenever you jump into raising capital, like what actually changes in these scenarios, instead of doing it alone, all you're going to be doing is the same thing. You find a deal with great opportunities, you can make a ton of money, and instead of having to come up with all the money yourself, you take it to other people and you raise money from other people. And yes, I always think it's important to have some level of skin in the game because you want to align your interest with investors. 95% or more of the equity that you're raising for these deals can come from other people. Now, the only difference that happens on these deals is because on the solo one, you bought it 100% by yourself, you keep 100% of the profits. Whenever you bring outside investors in, depending on how you structure it and depending on how big the deal is, and we will cover that in this video, so make sure you stay the entire way. You buy it, and then because you're using outside money, you're going to keep anywhere between 20 to 100% of the deal. Meaning, like for example, one of the last deals I did was a $24 million purchase, and we have an 80-20 profit split with the investors. 80% of it goes to the investors, 20% of it comes back to us. Some of you might be hearing that and think that's not a lot of ownership. Like, why do you give so much ownership away? It's a $24 million deal, and we got into it with very little of our own money. So 20% of a $24 million deal is a lot of actual dollars. And then on the smaller deals, you can keep a larger portion of it. Now that you understand the general idea of what raising capital is, again, you can go do it on movies, you can do it on tech ventures, you can do it on almost anything. We do it on real estate, specifically multifamily. Here are the rules of raising capital. It is like, let me just be blunt. This is not a side hobby. Like, this is not something that you want to test. This is a very high level of responsibility to raise money from outside investors. So do not take it lightly. Like, there's a lot of people that try to jump into this business, don't know what they're doing, have a terrible experience, lose a bunch of people's money. It's absolutely horrible. I hope none of you have to go through that. So these are the rules that I live by. I'll never break them. As long as you're in this business, you're going to be wealthy. The key word is continuing to play. So here are the rules. Rule number one, don't lose money. This comes from Warren Buffett. Rule number two, C number one, do not lose money. Rule number two, and this is a really important one, especially at the beginning, because most people, all they care about is lining their own pockets. How can I make money? How can I get a fee? How can I get all the ownership? I'm telling you right now, the sooner you realize that taking care of the investor first and you second, meaning make sure they get paid first, and then whatever's left over, you're cool with. If you take care of the investor first, you will always be taken care of as a byproduct because the investor sees this and they build trust with you and they continuously invest with you, not only in just one deal, but in multiple deals for the rest of their life. And it allows you to scale a portfolio as big as you want. Where I see a lot of bad actors fall is when they start putting themselves first and then treating the investor second. And then rule number 3 is to manage the expectations of the investors up front correctly. What I mean by this is if you know the project is not going to have any cash flow in the first year, tell the investor there's no cash flow in the first year. Here are the reasons why, and here are the reasons why we still think that it's a fantastic investment. Where investors get very upset at and do not want to reinvest with you is because whenever you tell them X, we believe it's going to perform here, and then the actual performance is here. And there's a delta between what they expect and what actually happened in a bad way. You do not want to do that. Tell the investor something you think is very conservative. We believe it's going to perform here, and what you actually deliver is above and beyond. And by doing that, the investor is attracted to continuously invest with you. Now, jumping over into like a higher level overview, you should have a general understanding of how you can go from stop trying to buying deals with 100% only your money and like thinking about jumping into larger deals by utilizing other people's capital. Now I want to move into like what does raising capital actually look like and then give you a couple of examples. Whenever you're jumping into multifamily or really any real estate, the first question you have to ask is where are you starting at? Are you doing smaller deals? Are you doing medium-sized deals? Or are you trying to jump into big deals? And the reason you have to define this is because it dictates the form of capital that you raise. For example, if I'm going out and I'm trying to do a small 10-unit deal, and it's $1 million purchase price, I have to get a loan for 70 to 80% of that, and then I have to come up with the rest. So $700,000 to $800,000 is going to come from a bank, and then that $200,000 to $300,000 can be raised either as debt or equity. And so getting clear on where you're starting at and what form of capital you're going to be focused on is super important. So let me explain how it works. So there's two forms. You have debt and you have equity. The biggest difference here is the risk that the investor is taking. If you raise money, say you're a single family home flipper and you're going out, you're getting a hard money loan, and then you're doing a private money loan behind it. And so you've raised all of the money as debt, meaning if you mess up on the property and the project doesn't go as planned, the first position lender can foreclose on you. Their risk is much less than you. And the second position lender has a lot less risk because they're not in the equity position. So they're not taking a part of the downside risk, and that's what makes debt so attractive, but they're also not taking a part of the upside. So if you can invest into a deal as debt, you're not taking on as much risk as the equity person because you're not taking part of the downside if the project fails, but you're also limiting the amount of return that you're going to get on your investment because you're not taking as much risk. And so that kind of segues into the second form of capital, which is true equity. So this is, I'm going out, I'm finding a deal, I'm getting a loan, and then the down payment that I'm raising is coming from investors, and they are a true equity partner, meaning they're taking part in both the downside and the upside. So these investors are getting cash flow every single month. If there is cash flow, the depreciation and the tax benefits that come with investing into real estate as an owner, plus the appreciation on a sale or a refinance. And that's really where all the money is made. But again, they are a true owner, which means they're taking the risk with you and they have to be comfortable with you. So I see a lot of single family home flippers that are trying to transition from single family into multifamily, and they're used to raising money as debt, which is a lot easier to get. And then they try to go move into the equity world, and it's a lot harder because the investors are taking the additional risk with you. So for example, here's a 10-unit deal. It's $1 million purchase price, plus you need 200 grand of rehab to make it worth $2 million. That means the total cost is $1.2 million, and we can go get a loan today for 75% of the cost. That means we're going to get a $900,000 loan from a first position lender. And now the first question a lot of people ask is, where in the world does this 300 grand come from? Well, that's what we literally just went through. You can either, depending on if this first position allows for second position debt, most lenders don't, some private lenders do. Here are the most simple two options. Option number one is you go get a second position loan, and this person's probably going to charge anywhere between 12 and 15% because it's not first, it's second position. They're second in line, and they want more on their money. They will give you 300 grand at 15%. And on this scenario, you have 100% leverage, meaning if this project doesn't go to plan, you are kind of SOL. Or moving into option number two, which is the equity portion. This is technically a lot less riskier than going 100% leverage because you're bringing the equity to the table. Is you can raise it from one JV equity investor. This is just one random person named John, Joy, Eldre, whoever it is in the entire world. They bring a $300,000 check. Now that they're a true owner, there is a profit split with all the profits that are produced to the property. So like on a 10 unit building, if we can get this thing to be worth $2 million once it's said and done, I could very easily see a 50-50 profit split on the property. So you got into $1 million asset that's worth 2 million when you're said and done with it without bringing any money to the table. And then depending on how you raise the capital, whether it's debt or equity, you can own 100% of the building by yourself using debt. You just take on more leverage. Or if you're looking to scale and you're looking to have joint venture partners fund your deals pretty much every single time, I would recommend going over to the equity side and setting it up where you do 50-50 splits and you do this every single deal from there on out. So hopefully that makes sense. And we will be going into this so much deeper throughout the entire series. Again, this is more of a higher level view of how raising capital works. I'm telling you, the reason there's so much confusion on this topic itself, there's so many avenues that you can go down with using raising capital as a skill set to make money in real estate. I want to cover the multifamily breakpoints just so you can see a general scope of where investors start in the business and what the natural progression is as they scale in the larger deals. All right, so here are the breakpoints. For the new beginner that doesn't have a ton of liquidity, can't bring a ton of the down payment, maybe doesn't have a ton of assets under them, younger, hungrier, jumping into the business, you're likely going to be starting with small deals. And a lot of the times you're trying to jump into the business to build 5,000, 10,000, maybe $20,000 a month of reoccurring passive income from your investment portfolio. And so you want to focus on taking care of yourself first. And then once you're there, taking care of the people around you or scaling and getting investors in. And so at the very beginning, you want to focus on doing smaller deals. You'll probably consider raising the money as debt so you can keep 100% of the ownership, or you might be looking at doing 50-50 JV deals with one other person like we just went over. These are 10, 20, 30, 40 unit deals. Something between $1 to $3 million is a really good starting range for most people. Now, the biggest thing to note here is at the very beginning, you are taking the most amount of risk because let's call it like how it is. You just don't have a ton of money. You need to jump into the business. You need to hit one or two deals where you can pick up hundreds of thousands of dollars of profit. Then once you have a couple hundred, you start building a little bit different from that point. As you've done your first deal and you're trying to figure out this whole scale thing and you're raising capital, this is where the JV partnerships and doing 50-50 is going to be a really important thing for you. So I call it the experience slash operator. So they've done a little bit for themselves. Maybe you're flipping a couple homes a year. You can manage a project well. You can manage contractors to get the job done. And you can take on the responsibility of bringing in partners and executing the business plan. You're likely going to be focused on finding JV partnerships that you can do 50-50 splits on. You can buy deals without using any of your own money or very little. Focus on operating it, making sure the business plan gets executed, and making sure that the investor is being taken care of from the returns that you're generating. And then where you see big people like Grant Cardone, the whole Cardone Capital thing, what we're doing at Bowling Capital, like we bought over $50 million of deals. I raised $7 million of equity. This is the big leagues. This is the securities business, syndications, funds, everything's registered with the SEC. And the big thing to point out here is this is a scale only business model. You have to do tons of deals to make it worth it because you're giving up the majority of the equity on these deals. Again, our last deal we did an 80-20 split on. It was a $24 million deal. So the fees and everything, it makes sense to do it, but you have to do it at scale. You can't do this on a small 10 unit deal and make a ton of money. So you have to be experienced. Like I see a ton of people that are brand new trying to jump into it. It just doesn't work that well from a probability standpoint. Most of the time on deals of this size, you have to bring the equity in. The lender will not allow you to bring it as debt. It's a fee driven slash profit split business. So we make decisions a little bit differently than somebody doing a 10 unit building because of the fees that we can charge. And I'll show you in the next video what that looks like. And the biggest one is on a 100 unit building, it takes physically 3 to 5 years to turn the deal to either have a big sale or a big cash out refinance. So this is longer term, bigger checks. It might take 3 years to pick up a couple $1 million on the deal, but it takes 3 years to actually realize it. So a lot of money, it takes a little bit longer of a period of time than most people are willing to wait. And then as you're scaling and you're getting the bigger deals, you generally give up more of the ownership. So you keep anywhere between 20 to 50% of it. So hopefully this is a good spectrum of like where you're at in the business. Maybe you're already doing smaller deals and you're trying to scale into the syndication world, or you're brand new and you're trying to get into your first deal. Maybe you have a duplex, a fourplex, a couple of single families, and you're trying to do a 10 or 16 unit. You're literally right here between the end of the beginner and moving into the experience. So after going through just a very high level overview of what raising capital actually looks like, a couple of the examples of how it applies to multifamily itself, hopefully you have a lot more clarity on how developing the skill set of raising more capital for your deals, or maybe for the first time, can literally change your life like it did for us. Now, throughout this entire series, we're going to be dropping a ton of value. So again, make sure you subscribe to the YouTube channel. Make sure you have the notifications on for every time we post. And in the next video, we're going to be bringing a ton more value on raising capital and the nuances and the marketing and the sales, every bit of information that I've compiled over the last 6 years of raising hundreds of millions of dollars at somebody else's company, as well as doing it at our own. I'm telling you, there's no other place you can get it. So make sure you're subscribed, and I will see you in the next one.